Hi everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And let me tell you, Jiuzi Holdings' latest filing is a real head scratcher with some numbers that will make you do a double take. So grab your coffee because we're diving deep into the SEC filing to see what's really going on behind the scenes. Jiuzi Holdings is a company incorporated in the Cayman Islands, but their actual business happens in China, mostly dealing with new energy batteries and electric vehicles. This report is an amendment to their annual report, basically meaning they forgot to include something important the first time around, which is always a good sign, right? Let's jump straight into the heart of it, the financials. For the year ending October 2024, Jiuzi Holdings reported a massive net loss of $55.8 million net loss in 2023. This is not a good trend, folks. Their cash flow from operations paints an even grimmer picture. They used $50.66 million in 2024, a huge increase from the $5.5 million used in 2023. This means their core business is burning through cash at an alarming rate. Things get really interesting when we look at their allowance for expected credit loss, which jumped to over $42 million in 2024. Remember that trial case against vendors for failing to deliver purchased vehicles and demanding refunds and damages. It seems like they've had to write off a significant amount of money advanced to suppliers, suggesting major issues with their supply chain. This is a red flag signaling potential financial distress with their partners. Now, their revenue is a bit confusing. For 2024, they reported $1.4 million in total revenue, with about $771,000 coming from what they call proprietary product, which are their own branded batteries, the rest over 600 resales of sourced equipment and accessories from third party. This might suggest they are struggling to sell their own products and are relying more on reselling others. Their gross profit for 2024 was a mere $72,000 on the Nandia on $1.4 million in revenue, which is a laughably low 15% gross margin. This means they are barely making any money even before accounting for all their other expenses. This points to a potential pricing problem or very high cost for goods sold. One of the biggest drivers for their increased general and administrative expenses is stock-based compensation, which skyrocketed to over $12 million in 2024 from about $1.7 million in 2023. This is a significant cost and might indicate they're trying to incentivize key personnel with equity, possibly to retain talent given the company's financial situation. Now there's some administrative housekeeping happening. The original filing was amended because they omitted an audit report for 2022, which is a pretty basic thing to forget. Jiuzi Holdings, like many other Chinese companies listed in the US, is navigating the complex landscape of the Holding Foreign Companies Accountable Act. This means if their auditors can't be inspected by the PCAOB for a certain number of years, their stock could be delisted. Their current auditor is based in Singapore, which is an interesting detail given the PCAOB's past restrictions on inspecting auditors in China and Hong Kong. But hey, at least they believe their auditors are compliant for now. Jiuzi Holdings is considered a controlled company by Nasdaq. This means a single entity or group owns more than 50% of the voting power. They can use this status to bypass certain corporate governance rules that aim to protect shareholders. This often means less independence for the board and potentially less scrutiny on executive decisions. Speaking of control, Shubo Zhang, the chairman of the board, holds significant influence with over 16% of the company's shares. This level of ownership means she can largely control shareholder decisions, which might not be in the best interest of minority shareholders. So looking at their share structure, it's quite a wild ride. As of October 2024, they have over 11 million shares issued and outstanding. Compare that to just over 12,000 shares in 2023. This massive increase is likely due to various private placements and stock issuances mentioned in the filing. It's a huge dilution for existing shareholders. The financials highlight that almost all of their income or loss comes from their operations in China. For 2024, the loss attributed to China was nearly $55.8 million. This reinforces the idea that their entire business is heavily reliant on the Chinese market dynamic. The company has been busy restructuring, selling off parts of its business. They disposed of Zhejiang Jiuzi New Energy Network Technology Co. in August 2023. And more significantly, sold their entire Hong Kong subsidiary Jiuzi HK Limited in November 2024, along with its various PRC subsidiaries. This is a major move, potentially signaling a pivot in strategy or perhaps an attempt to shed underperforming or problematic assets. The loss on this disposal was approximately $242,000. When you add up all the losses, including those from discontinued operations, Jiuzi Holdings ended 2024 with a total net loss of almost $59.1 million. Considering their revenues are just over $1.4 million, this is a company bleeding money. Their internal controls over financial reporting are also a concern. Management admits they don't have enough accounting personnel with US GAAP experience, leading to a material weakness. This lack of expertise in financial reporting is a significant risk for investors. So what's the verdict on Jiuzi Holdings? This company is in a precarious financial position. Their revenues are tiny compared to their massive losses and cash burn. The sale of subsidiaries and the huge allowance for credit losses suggest serious operational and financial issues. While they have a strategy to focus on electric two-wheelers and three-wheelers in Southeast Asia, the current financial health is a major red flag. The heavy reliance on equity issuances to fund operations, coupled with the internal control weaknesses and the potential for stock delisting due to auditor inspection issues, paints a very risky picture unless they can drastically improve their revenue generation and control costs or secure substantial further funding. The future looks challenging for Invested Professional Medium. Investors, this filing screams caution. It's a story of a company struggling to find its footing in a competitive market with significant risks in its operations, finances, and regulatory compliance. What do you think about Jiuzi Holdings' situation? Is this a turnaround in the making or a company teetering on the edge? Let me know your thoughts in the comments below. If you found this deep dive valuable, hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community, linked in the description for more in-depth discussions. Thanks for watching and see you next time on Corporate Decode.